with the management of LTIMindtree as well, and that is in focus on the back of a weak third quarter with revenue and margin, both of them coming in lower than estimates. Margins declined for the third consecutive quarter, and we will be in touch with the management in just a bit. Let's quickly take a look at the stock as well, because in a market like this, LTIMindtree is a stock which is lower in trade, 2.3%, and the brokerages indicate that it is an expensive stock in the Nifty bag as well. Nachiket Deshpande, the whole-time director and CEO of the company, join us now to discuss further. Nachiket, good afternoon. Thank you so much for joining us today. You know, you've spoken about growth returning in quarter one, that Q4 was a one-off, but the question is on the extent of growth revival given the stress in discretionary spending. Can FY25 be better than FY24 in that case?
So, as we said, I think the Q4 related impact was one-off. And based on the deals that have already signed and ramped up over the last 2 quarters, we will see a growth in our services revenue as we go into Q1. And we're confident of that returning in Q1. The macroeconomic environment, though, continues to remain as it was. Most of the inflationary pressures as well as geopolitical challenges have not improved in any sense around the world. So when the discretionary returns is still very, very difficult to anticipate for anyone. And hence, commenting on the overall FY25 numbers has been difficult. But since the momentum as we go into Q1 would be better and it will be on our positive side, we believe that our execution in FY25 would be better than FY24. But to the extent of the full year revenue trajectory, very difficult to predict given the macro uncertainties are still largely unresolved.
Good afternoon, Nachiket. So you're saying execution will be better in FY24, but still you don't have the confidence at the current point of time to say that FY25 will be better than FY24.
Yes, we will. So that definitely would be the case. It's just that you asked the question on to the extent how much better will it be. It's very difficult to predict given the external circumstances.
I am just getting into internals now. You had also highlighted during quarter 3 results that quarter 4 will be similar to quarter 3, which is around 0.7%. Yet growth has come in lower at 1.3%. So it's a miss of 2% versus estimates. What explains that?
So for Q3 to Q4, I think DC called it out in the earnings script as well yesterday. There were, in Q3, we had a much higher pass-through than we normally do, and we had called that out as well. So absence of that in Q4 also had an impact. Second, of course, the furlough return, which was gradual in nature through the quarter, and hence, the full benefit did not come back in Q4 as expected. The third part was the 2 cancellation in BFSI that we talked about. That was definitely unknown and a surprise element that developed during the quarter. And we also had some delays in ramp up. I think Sudhir talked about it in yesterday in earnings call as well, that few of the deals ramped up a little slower than what was originally anticipated. All of them have fully ramped up now, but in Q4, it had an impact in terms of the revenue conversion into our P&L. So those were the 4 reasons for that 2% gap between expectation.
Nachiket, so right now, will you be focusing on growth over margins? And what is the recovery or what is the guidance that you're giving as far as margin recovery is concerned?
So I think when we said that it's not about growth versus margin, but our focus has been and will be on profitable growth. The margin program that we had started and the certain investment decisions that were linked to that, those are the ones where we pushed it out by a few quarters because we believe that as the market conditions, when the market conditions improve, we want to be ready to capture that growth, and we wouldn't want to compromise on our ability to capture that growth. And hence we said, okay, we'll postpone the margin improvement program by a few quarters. But I think our focus on margin remains. Our medium term as well as our long term goal in terms of the range in which we want to operate, we will continue to work towards that. I think both the companies before merger as well as the combined company, we continue to remain focused on the profitable growth agenda.
Okay, let's talk about long-term targets. The target of revenue synergies of $1 billion and cost synergies, which will drive 200 basis points margin expansion to 19 to 20% by FY27. Are you on track to achieve that?
So as far as the revenue synergies are concerned, I think we have already seen a fair bit of success in this cross-sell and upsell initiatives that we talked about. And I think we called out a number of deals that we closed even in this quarter, which were representative of that cross-sell upsell potential. I think the key piece for us is to now scale up that program and to be able to roll it out to at least the Focus 100, as we call it, within the organization. And that's what our focus in FY25 would be, is to scale up this cross-sell upsell program to our Focus 100 account base. And that, in a way, will help us work towards that $1 billion synergy revenue mark. So I don't think we have any doubts on our hypothesis for that $1 billion revenue synergies, and we are on track now to execute to that better in FY25, as we have now also learned and fine-tuned our program based on the experiences we had in FY24. The margin expansion program of 200 basis points, I think we continue to, it continues to be our focus. It continues to be the target that we want to go after. Whether FY27 is it possible or not, I think it's a little difficult to say today. We'll continue to work on it. I think as our FY24 plans got pushed out by quarter, we'll try to catch up as much as we can over the next 2 years. But I think as it develops, we'll probably be able to in a better position to say if there needs to be any correction or not. But at least at this point in time, we continue to work towards the same target.
One worry that analysts have, and it's fructified in Q4, where there have been a couple of deal cancellations. So Q1 and rest of FY25, are you worried about deal cancellations continuing that we saw in the quarter gone by?
No, those were very one-off, focused on specific programs, and it was more in terms of the the market situations that result into those customers reprioritizing their spend. But we don't expect any such situations going forward, at least based on the current deals. We don't anticipate any of those.
Okay. So can you give us a sense, because top 40 clients, we've discussed that as well, witnessed some signs of insourcing. What is the loss, if you can quantify that in terms of revenue due to this?
We haven't really quantified that. I think, as we said in our earnings call also, what we saw is that on one hand, certain accounts within our top 40 saw a decline due to insourcing and various other reasons as well, including discretionary cutbacks and so on and so forth. But we also saw the other service lines or our cross-sell, upsell stepping up to compensate for that revenue. So actually, if you look at in a full year basis, our top 40 accounts also grew slightly ahead of our company average. So from that perspective, I think there is a sort of balancing act. We haven't really quantified a loss due to insourcing per se as a single reason.
Well, the next question that we have is on headcount or on hiring. Headcount was down almost 2,900 in FY24. What is the outlook on hiring going forward?
So I think in the post the merger, we had actually called this out, that as combined organization, as we come together and as the systems get consolidated, we have a better visibility of the combined bench. We will focus on efficiently utilizing that bench, and hence, our headcount, overall headcount, net headcount would be moderated, and don't look at that as an indication of the growth prospect. And we saw that played out over the last 3 to 4 quarters. I think post pre-integration, we used to operate at 80% utilization as individual companies plus minus. We're now operating at 86 to 87% utilization as a combined company. Right? So that a large part of that is coming through the headcount reduction has come through that efficiency of having better visibility of bench and better deployment of those bench in our programs. I also called out that I think 85 to 86 is our comfort zone from a utilization perspective to balance our growth aspirations and the efficiency that we're looking at. So we probably are maybe about 100 basis point higher than our comfort level. And as we see the growth returning, we had some drop in the utilization this quarter, and we expect some more drop in utilization as we get ready for capturing that growth. So we'll operate in that 85% to 86% utilization range. And with that and the growth that we are seeing, I think definitely we're seeing a better trajectory on our headcount growth as well as we go into FY25.
Okay, all right, Mr. Deshpande, thank you so much for joining us with those insights. So that's the word coming in from LTIMindtree, the stock lower in trade today. We'll sip into a break now. When we return,